This is the Commodities Trade Institute podcast. I'm your host, Emily Costa, and today is Friday, April 17th, 2026. We're going to begin today in the metals market, where supply chains are proving resilient but not untouched by escalating geopolitical tensions. Brazilian mining giant Vale has reported its strongest first-quarter iron ore sales in 8 years, reaching nearly 69 million tonnes. That's a notable signal of underlying demand stability, even as the broader market grapples with disruption. Production rose modestly, supported by stronger output in southeastern Brazil, while copper and nickel volumes both climbed by more than 12%. But beneath those solid numbers, there's a more complicated story unfolding. Vale has suspended operations at its pellet plant in Oman and halted construction at a key concentration facility there, citing risks tied to the Middle East conflict. That's important because it reflects a growing theme across commodities. Production may be holding steady, but logistics and regional processing capacity are increasingly vulnerable, and that vulnerability is showing up elsewhere in metals markets as well. In India, banks have abruptly halted imports of gold and silver, leaving more than 5 tons of gold and 8 tons of silver stuck at customs. The issue isn't demand, it's policy uncertainty. Without a renewed government directive authorizing imports, shipments have effectively frozen. This creates a paradox. On one hand, reduced Indian demand could weigh on global prices. On the other, domestic shortages could emerge quickly, especially with major buying festivals approaching. It's a reminder that in commodities, policy friction can be just as disruptive as physical supply shocks. From metals, let's move into agriculture, where the ripple effects of the energy crisis are starting to reshape planting decisions and production forecasts. In Western Australia, farmers are preparing to plant fewer crops this season, driven by rising fuel and fertilizer costs linked directly to the Iran conflict. Instead of wheat, many are shifting toward barley and canola, crops that offer better margins under current conditions. This is a subtle but significant shift. Wheat is a global staple, and even marginal reductions in planting area can tighten supply balances over time. Meanwhile, canola's expansion reflects a broader trend toward crops that can better absorb cost volatility. At the same time, Argentina is moving in the opposite direction. The country is on track for a record corn harvest of 61 million tonnes, thanks to expanded planting area. That's a substantial upward revision and underscores how regional dynamics can diverge sharply. But even here there are complications. Heavy rains are slowing soybean harvesting, and logistics remain a persistent challenge. So while production potential is strong, getting crops to market efficiently is another matter entirely. And then there's Brazil, where soybean exports are expected to hit a record 113 million tonnes next year. But despite that surge in volume, revenues are projected to decline. Why? Because global prices are falling under the weight of abundant supply. This is one of the clearest examples of how commodities markets can decouple. You can have record production, record exports, and still see declining revenues. It's a volume story, not a price story. Now, let's turn to energy, where the geopolitical backdrop continues to dominate every aspect of the market. Nearly 7 weeks into the Iran conflict, the Strait of Hormuz remains effectively closed, disrupting roughly 1/5 of global oil and gas flows. The impact on pricing has been dramatic but uneven. In Europe and Asia, physical oil prices have surged to record highs. European benchmarks are nearing $150 per barrel, while Middle Eastern crude has approached $170 per barrel, levels never seen before. But in the United States, the story is very different. Domestic crude prices have actually retreated from recent peaks. Mars crude, a key medium sour grade, has fallen to around $97 per barrel, down sharply from over $128 earlier this month. What's driving that divergence? 2 key factors: strategic reserves and alternative supply. The US has released roughly 172 million barrels from its strategic petroleum reserve, injecting significant volumes of medium sour crude into the market. At the same time, imports of Venezuelan crude have risen, providing an additional buffer. Together, these flows are insulating the US market from the full impact of global disruptions. While Europe and Asia are scrambling for physical barrels, US refiners are relatively well supplied, and in some cases even acting as price setters, but that doesn't mean the US is immune. California in particular is beginning to feel the strain. Gasoline inventories in the state have fallen to their lowest levels on record, and prices have surged to nearly $6 per gallon, far above the national average. The reason is structural. California is geographically isolated from the main US pipeline network and relies heavily on imports from Asia. As those supply chains tighten, the state becomes one of the first places where global disruptions translate into local shortages. And critically, the worst may not have arrived yet. Shipping delays mean that the full impact of reduced imports could take weeks to show up at the pump. When it does, the squeeze could intensify quickly. Staying in energy, there's also a notable development in liquefied natural gas. The Golden Pass LNG facility in Texas, one of the most anticipated export projects in recent years, has withdrawn its initial cargo offerings. The plant is currently operating at roughly one-third of its capacity during the commissioning phase, and while production has begun, exports have yet to materialize. This adds another layer of uncertainty to global gas markets, which are already tight due to the loss of Middle Eastern supply routes. Every delayed cargo matters in an environment like this. Finally, let's touch on carbon and power, where policy shifts are beginning to intersect with market realities. The United Kingdom has announced it will scrap its carbon tax on electricity generation starting in 2028. The move is aimed at reducing power costs for consumers and businesses, particularly as energy prices rise in response to the current crisis. The tax, which was originally designed to accelerate the transition away from coal, has arguably achieved its goal. Coal has been effectively phased out of the UK power system. Now, the focus is shifting toward affordability. This decision highlights a broader tension in energy policy. Governments are balancing long-term decarbonisation goals with short-term economic pressures. And in times of crisis, affordability often takes priority. Across all these markets, metals, agriculture, energy and power, the common thread is clear. We are in a phase where supply is not collapsing outright, but it is being rerouted, delayed and reshaped by geopolitics, policy decisions and structural constraints. And that's creating a world of divergence. Prices are moving in different directions depending on geography. Production is rising in some regions while falling in others. And policy is playing an increasingly active role in determining outcomes. For traders, producers and consumers alike, this is a market defined not just by scarcity, but by fragmentation. And that fragmentation is where both the risks and the opportunities lie. If you found this episode valuable, be sure to subscribe, share and leave a review. Find us online at commoditiesinstitute.com.